Hello, Jim here. Trading options is a great way to make some extra income. Today, I want to share with you a new strategy. I keep making small modifications to what I call my wheel strategy. This week, I'm going to share with you how I'm using vertical put credit spreads to potentially earn $10,000 a month on around a $200,000 portfolio. I'm going to share with you the strategy in more detail. I'm also going to share with you some trades I just made this past week that have gone really well. So stay tuned. I think you're going to find it well worth your while. Okay, let's jump right in. Just a few comments about the current market. It's been fairly crazy market since Trump won the election. Some sectors have gone through the roof while other sectors have kind of struggled. One thing I have noticed, I just wanted to share with my subscribers and members, is some sectors, especially consumer products and the pharmaceutical sectors, are kind of being hit hard. And I'm not surprised. I think it may continue. With Kennedy being the czar or the hell czar, I'm not sure he has an official title yet, but he's definitely going to go after the pharmaceutical companies to be sure that the vaccines and a lot of the stuff they're doing medication-wise is being thoroughly tested. In a lot of his interviews, he did talk about the fact that with his own research, the pharmaceutical companies really weren't doing the research they needed to do. So just something to keep in mind. I like to invest in Johnson & Johnson. I don't invest in Pfizer. But some of the other pharmaceutical companies I've traded in the past, I'm probably going to hold back a little bit and just be a little bit more concerned. I also think that's true with the consumer staples, especially, the food product related companies, like even Coca-Cola. Coca-Cola has dropped from the low 70s into the low 60s. Suddenly all my long-term covered calls are very profitable. I only have maybe one in the money currently, where all of them were in the money literally a week or so ago. But another story that Kennedy mentioned is he researched McDonald's, he researched the French fries at McDonald's, and he found here in the US there's 17 ingredients in a French fry. Overseas, Europe, and pretty much every other country, there's only 3 ingredients for any French fries. And I think he's going to push that. A lot of the stuff that's in our food here that's allowed here, but not overseas, not in Europe, not in South America, not in Asia. Suddenly, a lot of those ingredients that are not good for us will be banned, hopefully. It's something I want to see. I do feel it's impacting our health. So that's another sector. Be a little bit wary of it. It's partially why companies like Coca-Cola are being hit pretty hard right now. And then I always like to mention about what I think is going to go on with the Fed. I really do believe that the Fed may not cut rates again this year. I'm thinking, depending on what happens next year, they may cut or they may not cut at all. At least that's the sneaky suspicion I currently have. So, and it's my 2 cents, and it may only be worth 2 cents. But I just wanted to share that with you guys before I jump into the main topic in this video. So I keep modifying. I'm one of those kind of traders. I stick to what works and I make small modifications, try to make it better. So that's what I want to talk about today. I'm doing the wheel strategy a little bit different. I'm using spreads, vertical put credit spreads versus cash secured puts, primarily with the idea of buying the puts for protection and buying them fairly cheap. I've been able to buy most of them at like $15 or $20 a contract. And when you're bringing in close to 200, when you're selling a put, that becomes well worth it. So, and I found when I've looked at my previous months and I filter and I look at just vertical put credit spreads and cash secured puts, I've done a lot better with the vertical put credit spreads. So it just made me think maybe I need to do the wheel slightly different. So this is like my 3rd iteration or 4th iteration of different types of wheel trades. So, and again, I'll be sharing that in a spreadsheet at the very end of this video. I'll go into details of what the trades look like. I'll also share with you the 4 trades I did earlier or late last month related to also the wheel. These were monthly cash secured puts in companies like Pinterest and Chewy and I believe Square and Twilio. So we'll also talk about that briefly. So what's the difference compared to the normal wheel? I mean, you're still picking good companies that you want to own. You also, you realize that price matters and you're trying to get into the stocks at a good price. You're looking at things as the debt, that they have, an okay debt to equity ratio. I prefer to see below 50%. They have a good return on equity. I'd like to see higher than 15% return on equity or return on assets, again, maybe in the teens or higher. And then also good profit margins and also good cash from operations is really important. I use Seeking Alpha and I look at all those things. So none of that's really changed when you work with any of these kinds of strategies or any of these trades. Picking the right companies takes a lot of the pressure off. If you were not selling options and you were just buying stock, you wouldn't do as well. Just a quick example, if you're looking at a stock that's $50 and you sell a put on it at 45 and then you get assigned at 45, you're still better off at that 45 than the initial purchase at 50. And I think a lot of people forget that. One of the negatives of trading options is you're looking at the market more than you should be. Many years before I ever got into trading options, I would only look at my accounts maybe a couple times a year. Now with trading options, you definitely look at them a lot more, which means emotions get involved, and that emotional maturity is important. So you don't buy high and sell low. You want to buy low and sell high. So just wanted to mention that the core, any of these type of strategies, the core piece or the piece that's going to make you a good trader is, again, picking the right companies at the right price. And some companies right now have shot through the roof, and they are not, in my mind, my humble opinion, they're not at the right price. Like Palantir, I think, is too pricey. Even APP, the AppLovin company, they're they shot up, I think, 100 points this past week. And even companies like Shopify have shot up and they've gotten quite pricey. So now, again, this is like the normal wheel that I've typically done, but the only addition is it's the wheel, and I'm just buying a put along the way, mainly because if we do get a downturn or we get a black swan event, I'm protected by having that put. And it's inexpensive protection. If you do a $10 spread, it can be relatively cheap. I'm looking at companies who are not overpriced. So typically the $10 out or $5 out put, the long put, is typically not that expensive. Like I said, I'm spending $15 to $20 per contract, which in my mind is relatively inexpensive. I'm also, with this new type of trade, I'm doing a shorter expiration. So I'm trading these, trying to do it every 10 days, but I'm looking at more averaging like 15-day expirations or DTEs. So the ones I did yesterday expire a week from tomorrow, the 22nd of November. And by doing that, the companies I'm going to share with you at the end of the video have better premium typically on a weekly basis compared to some of the other ones, like my previous wheel trade or 4 trades where, again, Pinterest, Chewy, some of those companies, they didn't have as good weeklies. So the companies I'm sharing with you today do have fairly good weeklies. And of course, the big boys have good weeklies. The NVIDIAs, the Apples, the Microsofts, the Amazon, the Tesla, those guys always have fairly good weeklies. So I'm going with a shorter expiration. I'm also going with a bit of a higher delta. Again, it's important to pick a company that's not way overpriced. So you'll notice the companies I share with you are not majorly overpriced. They're not necessarily bargains, because I'm not sure anything's a bargain right now, but they're not way overpriced. They're almost fairly priced, is how I'd like to put it. And then the idea with the wheel, it doesn't really change. So if it gets assigned to me, I'm also going to do that. I'm probably going to sell a covered call around a 35 delta or maybe a little bit higher. The emphasis is to be above your cost basis. So if I sell a put at 35 and it gets assigned to me at 35, but I brought up I brought in $1, my cost basis is 34. I'll probably sell a covered call at 35, 36, somewhere along those lines, with the idea of bringing in quite a bit of premium for that call. And then again, if it gets assigned away from me, then I just do it all over again with around a 35 delta. I'm taking more risk, but I'm bringing in a lot more premium. Now, these trades won't necessarily work every week or every month. Sometimes, and once you've been trading options for a while, you'll notice some trades work one month and then the next month they don't. There's very few trades that work every week and every month in and out. Maybe with some of the ETFs, maybe IWM or SPY might be along those lines. But with common stocks, things change, or ETFs, things can also change, but not as much as common stock. Meaning the companies have news, they have earnings, and so the volatility can change quite a bit every month, and especially around earnings, the volatility will go way up. Earnings is very risky. So that's rinsing and repeating. That's, again, running it all over again. And if you're doing it every 10 to 15 days, you can potentially run the trade more often, like 2 or 3 times on a monthly basis, bringing in a lot more cash. So next, let's jump into the spreadsheet that I have set up, where I have the previous trades that I talked about a couple weeks ago, and then some new trades that I did this week. Before I do jump into that, as always, please hit that like button, subscribe. I'm trying to get the word out. I want people to learn that they can do this, and it can be a godsend, especially if you're looking at retirement. I'm 59. I'll be 59 and a half. I do most of my trading in my retirement accounts. So at 59 and a half, I can start accessing them. And at that point, I'm one of those, I'm not sure I'm ever going to completely retire, but what I will do is do what I want to do when I want to do it with who I want to do it with. Financial independence, or FU money, more so than retirement. I do like to work. I like to teach people. I do have one more client for my software company. So retirement will be kind of a mixed thing for me. It'll be working less and doing more of what I want to do. And then, as always, if you want to take a look at my memberships, one thing they're growing. I have a lot of members in the Discord, which you can only use the Discord if you're in the higher 2 tiers. I'm thinking about sharing some of my members' trades going forward too. I may pick one trade because they're all sharing their trades now. There's a lot of winning trades, a lot of, they've actually asked me to add a risk area, like a risk channel, because they are taking a little bit more risk with certain trades. So there's a lot there. It may be worth your while to check it out. Details will be in the description. Again, it's growing and it's becoming quite active. I'm still sharing my trades both in Patreon and Discord, but it's real interesting when I see all the trades that other people are doing. And I've actually taken some of those trades and looked at modifying the way I do trades. And in some cases, they take my trade, but they make modifications and do it slightly different. So that's what I wanted to share. Let's go ahead and jump into the next part of the video. Okay, here is my updated spreadsheet. And again, this is the new wheel, and I'm going to be doing vertical put credit spreads and also vertical call credit spreads. I forgot to mention that in the beginning of the video. I'm not just going to buy long puts, but I'm also going to look at buying long calls. If you're like me and you own some stock in Shopify and some of the other companies that have shot through the roof, by purchasing a long call, you don't miss out on all the upside. All you miss out on is the spread minus whatever your premium is. So I typically talk about vertical put credit spreads, but again, in this situation, it's not going to be a vertical put call credit spread. It's going to be a covered call credit spread, if you get my drift. So I've done 3 trades. One was Micron. The first 2 I did in my regular Fidelity account. The third one I actually set up within Thinkorswim, and I think I may show those pages in a different video, what it looks like to actually do a paper trade within Thinkorswim. But we'll talk about that a little bit more when we get to it. So Micron, I did 2 days ago. I did 2 contracts, 190, and I don't think Micron is overpriced at 100. And it was right around a 35 delta, expiring on 11/22. So literally 12 days later, I brought in 323 premium, which is quite good when you consider it's only for 10 days. I believe 10 days. Yeah, 10 days, because the expiration is November 22nd. And then the call premium, I also looked at the call premium at the same time. This is the call premium for if I ran a covered call, if these shares were assigned to me at 100 and I went up to the next higher strike to sell the covered call, I'd actually even bring in more money, nearly $435. The required capital is the 2,000 minus the 323.28. So that's how I came up with the 1678. And if you looked at this on a yearly return, it would be almost a 704% return. So, and this is the assignment allowance. So if they're assigned to me, I would need at least pretty close to 20,000, 19,678 or 676, 72 in my account to be able to, cover the assignment of the shares. Because even though the required capital is there, this is what I would need for an assignment. Now, having the protection on the downside, if there's a major drop, which, when you ran trades like this, it might happen on occasion if there's a black swan event. This put that I would have purchased, which in this case was $90, would become worth quite a bit. Say Micron dropped all the way to $60. Well, that $90 put would be worth quite a bit and would help me in protecting from the downside. So the next trade was actually, this is Lam Research. A lot of these are chip companies, so Lam Research. I haven't traded in them before. I do like their pricing. So I did a 72.50 is the short, and in the 65 put I purchased. So a $7.50 spread versus a $10 spread. So a little bit less, a little bit of a smaller spread, expiring on the same day, 11/22. This was 0.364 delta, so a little bit higher delta, but I brought in 243. So I didn't bring as much in as Micron. Micron just has lots and lots of premium, but on the call side, the premium was really significant. I could potentially make 620. So if it's assigned to me at 72.50, it was right around 73, but I could make nearly $600 by selling a call right around 72.50. This total is just this value. Again, you don't really need to worry about that. And then the required capital, because again, it's 750 times 2, so that it was 1,500 minus the premium minus this 243. So that's where I came up with the 1250, 670. And this one also had a really good return. I believe I did this one. I did this one on the 13th versus the 12th, which meant it was a 9-day. So it was the 320, the 243. Uh-oh, I might have a little typo there. It 243, so this should be changed. I wonder if I grab the value from up here. Yeah, so this should be 243. Let's fix that right now. So it won't be. So bear with me here, guys. I forgot to put the equal sign in. Try not to hit that delete button because the video will stop. So still a very, very good return. The required or the assignment allowance, I would need 14,256. So it worked out quite well. And if I can repeat these every 9 or 10 days, you could see how much income I could bring in. And then next was Qualcomm. This is a paper trade I did in Thinkorswim. If you're curious and want to learn more about Thinkorswim and how to paper trade, when you log into Thinkorswim, it's actually a choice in the login screen. At the bottom of the login screen, you can be live or you can be paper. And they do a nice job. So as I get used to Thinkorswim, mainly because I've been on the old Schwab platform for so many years, that I'm going to go ahead and start doing more and more trades in Thinkorswim. I do like it. It's just very different from what I've done before, but I was able to execute this trade. And this was two contracts, 157, 148. So again, not quite a $10 spread. This was a 37 delta. Again, I'd felt like Qualcomm at 157.50 wasn't overpriced. If I actually looked at the valuation within Seeking Alpha, it was fairly valued, and I brought in 334. Again, this is paper trading, but if I had done this live, it would have been about the same. And then the call premium was really high for Qualcomm. So like Micron, Qualcomm also has quite a bit of premium on the call side. So if I get it assigned at 157.50, I could turn around and sell a covered call and bring in some really good premium. And then again, I can rinse and repeat. If I get assigned, I could then sell a cash secured put and continue. So this required capital is again 334 minus, or 2,000 minus the 334. And this was like an 813 return, which I have 327. I must have copied it and forgot to change it, but it would be a little bit higher if I change this to 334. Yeah, you're talking a little higher, 813. So these are crazy returns, and it's mainly because of the DTEs. This was also a 9-day DTE. So it's just the interest divided by the spread and then adjusted for the year. And it's just so high because of the adjustment for the year. And then the assignment allowance is 31,166 or 31,166. If I'm assigned, I would need that much cash. And that's just the 157.50 times 200 minus the premium that I did bring in of 334. That's how that's calculated. And then that's a total assignment allowance of 65,000, but then the required capital is only 45.99. So you could also play this with not wanting assignment and always closing when you're profitable, and that's where the required capital, that's what the brokerage would require you to have in your account. Now, what are some of the, well, we'll jump to the notes last. So the total put income was $1,350, and I'm multiplying this times 1.5. So I'm saying I can make this 900 each time. So I made 900 on those three trades, and I could potentially do it 1.5 times each month, which is really low. I could probably do it more like 2.5 times potentially. And then I could also once each month maybe do one covered call once it is assigned to me, which is just this value right here. So kind of a little bit of estimating here. And in interest, this is the actual interest that the account is paying. And actually, that's the exact amount. I talked to Fidelity yesterday. That's what I'm getting on the account. And then monthly income, would be $37.32. And then yearly income, $44,788. Well, since you're starting with 65,000, I mean, you could see how much income you could potentially make. And then total required capital, again, 4559 or 4599. And then for total assigned capital, 65,099. And some of the notes, spreads are the most profitable trades if I filter by September monthly. So I went back and I looked at my monthly for September, and I filtered just for vertical put credit spreads. And I had right around a 5.25% monthly return on those particular trades. And then when they did go against me, the puts on the downside really did protect me. I could do a few trades like this to significantly increase my monthly income, like I did this week. And then using a 35 delta for this kind of a trade, the stock needs to be priced right and not run up like APP, Shopify, Palantir, and NVIDIA. Those are four that it shot up quite a bit in the last week or two. And then the call premium is really good. It can be double the put premium. However, it does fluctuate. Like any of these, the premium doesn't necessarily stay the same. I used to share like I have my favorites in the favorites tab, which is I was showing here. And I used to put what the premium could be and that kind of stuff. But then by Monday, it completely changed. So it was a waste of time. So now I just provide, we can look over here real quick. I just provide the basic information of my favorite companies. And that comes, I share that with my membership every week. I typically send it out on Sundays. And then the yellow is just, I like the company, but it's too pricey. So like Shopify, too pricey. AppLovin, APP, too pricey. I like the pricing on these. Palantir, too pricing. Johnson & Johnson. And again, I'm rethinking Johnson & Johnson. I'm not sure. But Qualcomm, I think, is fairly priced. Pins and then Lam Research, not necessarily overpriced. And again, I share that with my memberships. In my planning worksheet, it's all in one place, makes it really easy to find and to deal with. The long put can be a hedge for major market drop, and in most cases they were really cheap. And then also do call spreads. This is what I talked about a second ago. When assigned, might do a smaller spread since the premium is so good. So you could, if a situation occurs like what's occurred with these guys this past week, Palantir shot through the roof, and then APP is just unbelievable how it just went through the roof. I do think it's going to drift back down. I believe it's down $4 or $5 today, but it went up $100 in 1 week. I've rarely have ever seen that happen. Now this is, I have a up here. These are the trades I did in one of my previous videos. So these are all getting ready to expire. They all, if I still have them, will expire tomorrow. So these two, Chewy and Square, will expire. Twilio I've already closed because it just, another one that shot through the roof. So I closed those for dirt cheap. I think I paid $8 or $9 total to close them all. And the only assignment may be Pinterest. So I may get assigned Pinterest and then come Monday, sell covered calls. And then I would also probably open up new trades either in these guys or somebody different. And I'll share all that with my membership come next week. But with these, I was making $9.65, and it also has the interest. So down at the bottom, I was combining these two, because what I'm finding is I have a bunch of different strategies each month within my account. So if you combine the two accounts, so the 65 here and then the 24,334, you're talking 89,423. So if you had nearly a 90,000 portfolio, you could potentially make this amount of money if you look at these above. And I was able to make, this is what I was able to make up above. And then if you adjust it for a $200,000 portfolio, you could potentially make upwards, here even higher than 10,721. And that's what I'm finding. I'm actually finding I probably need to do more vertical put credit spreads. Being that I'm still working and I have limited time, a lot of my members actually do a lot more trading than I do. I'm kind of amazed at how many trades some of them can put on. But this is what I'm looking at. I'm probably going to continue to do this, and I think it's going to help me to get to an even higher monthly premium basis. Last month was my highest month, and I think it'll probably continue. So that's what I wanted to share with you guys. Let me know what you think. Are you doing something similar to this? Are there other companies that you like that have really good premium that you're looking at wheeling, either as a cash secured put or a vertical put credit spread? Let me know. Leave a comment. I try to reply to the comments within 24 to 48 hours. And I really like to hear from people. And as always, I really do appreciate you guys. And thanks for taking the time to watch the video. And I look forward to seeing you next time.